The Fed has just cut interest rates, again. But what you're not hearing is far more important. This isn't just about lower rates. It could signal the biggest shift in global finance in years. For months, markets have been riding high on optimism. Inflation showing signs of cooling, layoffs creeping up, and central banks under pressure. Now the Fed has moved. It reduced the benchmark rate by 25 basis points, bringing it down to a range of 3.75% to 4.00%. On the surface, it seems like good news. Cheaper loans, more liquidity, and a potential boom for stocks. But the truth hides deeper. What nobody's fully talking about is why the Fed made this move, and what they're really saying about the economy. First, the data behind the decision is shaky. Due to a government shutdown, key employment and inflation figures are delayed. Second, the Fed explicitly warned they're not committed to more cuts. In fact, the committee said a further reduction is not a foregone conclusion. Third, markets expected a series of cuts and a soft landing, but the Fed is only offering one step right now. That means expectations will need to be adjusted. The rate cut looks like stimulus, but the Fed's language suggests caution. That makes this move less of a rally kick and more of a warning. So what's really behind the cut? The labor market is weakening. Job growth has slowed. Unemployment ticked up. The Fed sees trouble ahead. Inflation is still somewhat elevated, and the Fed is worried about being too aggressive in easing. They don't have the luxury of full data clarity. Global conditions are unstable. Trade tensions, geopolitical risks, supply chain issues, all feed into the Fed's risk calculation. In effect, the Fed is signaling, we're cutting now, but we're not on autopilot for more cuts. The consequence? Markets may cheer the cut today, but the message could dampen hopes for a bold easing cycle. Investors looking for a Fed puts moment might be disappointed. What does this mean for you, the investor, saver, business owner? For stock and asset markets, don't assume the rate cut equals unlimited upside. If the Fed holds back further easing, risk assets may stall or reverse. For borrowing, this is still historically low, but rates could stay elevated longer than expected. Plan accordingly. For savings and cash, the yield on safe assets may hold up better than you think. Don't ignore them. For your business or side hustle, if you are banking on cheap credit or a meltdown in competition, the window might narrow. In short, the Fed's move is a pause, not an open door. The future path is conditional. Be ready for either scenario, upside if growth rebounds, downside if the labor and inflation mix worsens. So what do you think? Was this rate cut a signal of confidence, or a first step in a cautious approach? Let me know in the comments. And if you want to stay ahead of how money, markets, and power move in the world of finance, hit subscribe. This is the Wealth Report, and we're just getting started.